If I told you that gold at $8,000 is not the peak, and that $10,000 is no longer unrealistic, would you think I am exaggerating or telling the truth? In this video, we will not use clickbait. We will speak only with data, history, and financial logic. This is not investment advice. This is a personal analytical perspective for reference only. You are fully responsible for your own decisions. Gold has existed for more than 5,000 years. But the modern fiat monetary system is barely over 50 years old. Many people say gold is too expensive, but in reality, money is becoming cheaper. In 1971, 1 ounce of gold cost $35. Today, that number is hundreds of times higher. Gold has not changed. Only the purchasing power of paper money has changed. The US dollar has lost more than 98% of its purchasing power since 1913. This is not an opinion. This is historical data. 1 ounce of gold in 1970 could buy a high-quality suit. 1 ounce of gold in 2026 can still buy a high-quality suit. Gold does not make you rich. It simply prevents you from becoming poor. The world is facing a crisis of confidence. Global debt has surpassed every historical limit. The United States alone is carrying unprecedented levels of debt. No country can realistically repay this debt. The only solution is printing more money. And printing money always leads to inflation. When money is diluted, gold becomes more valuable. This is not a forecast. It is an economic rule. Central banks do not talk much, but their actions are very clear. They are buying gold at record levels. This trend has continued for several consecutive years. Central banks do not speculate, they prepare for systemic risk. They understand what the crowd does not yet see. When the largest buyers are central banks, that is never a random signal. The Federal Reserve is in a difficult position. If it keeps interest rates high, the economy slows down. If it cuts rates, the US dollar weakens. Both scenarios are favorable for gold. Negative real interest rates have always fueled gold rallies. History has proven this many times, and 2026 is unlikely to be different. Many believe gold at $5,000 is already too high, but they forget to compare it to money supply growth. Global money supply has expanded exponentially. Gold has not yet fully caught up when adjusted for real inflation. Gold remains below its historical peak. That is why the long-term trend remains upward. For gold to reach $8,000, nothing extreme is required. Existing trends simply need to continue. A gradual weakening of the US dollar, persistently negative real interest rates, capital flowing into safe haven assets, continued central bank gold accumulation. This is a very realistic scenario, and it can happen within 2026. $10,000 sounds extreme, but financial markets always overreact. It takes only one major shock, a debt crisis, a serious geopolitical event, or a banking system failure. Capital will panic, and gold becomes the final refuge. At first, people laugh at gold, then they doubt it. Then they watch from the sidelines. Finally, they rush in out of fear of missing out. Market tops usually form when everyone talks about gold. When people with no financial background promote gold, that is when caution is required. People holding large amounts of cash, those preparing for retirement, long-term investors, large institutions, and nations protecting their reserves. You do not need to buy gold at any cost, but you need to understand what is happening. $8,000 is a rational scenario. $10,000 is extreme but possible. Markets do not operate on emotion, but humans do. And emotions create the strongest rallies. History does not repeat, but it often rhymes, and gold may be preparing for a very powerful rhyme. To understand how much upside gold still has, we must compare it to other assets. Stock markets have risen for decades, fueled by cheap money. Real estate followed the same credit-driven expansion. Gold, however, was ignored for long periods of time. When we compare gold to the Dow Jones Index, gold is still historically undervalued. This suggests gold has not yet entered the final stage of its cycle. Another critical factor is gold supply. Global gold mining is facing increasing challenges. Production costs continue to rise. New discoveries are becoming rarer. At the same time, demand for gold is increasing. When supply cannot meet demand, price pressure moves in only one direction. The gold market is not only physical gold. Most trading happens in paper gold. Paper gold can be created almost without limit. Physical gold cannot. When confidence in paper gold declines, demand for physical gold explodes. That is often when gold prices move rapidly. Smart money always moves before the crowd. Large funds have begun increasing gold allocations. They do not announce it loudly, but the data clearly shows the shift. When institutional capital enters, long-term trends are usually already established. Geopolitics now plays a major role. Global conflict is no longer isolated. Instability has become persistent. In such an environment, gold is prioritized. It is not tied to any government. It is not controlled by any central bank. That is why gold is considered a neutral asset. The US dollar remains the global reserve currency, but that dominance is being challenged. Many countries are reducing dollar exposure. This process is slow but steady. Every step away from the dollar is a step closer to gold. Official inflation numbers do not reflect reality. Living costs rise faster than reported data. People feel this daily. When trust in data declines, trust in tangible assets rises. Gold becomes the first choice. Many investors still do not believe this scenario. They focus only on current prices. They ignore long-term trends. Short-term corrections scare them out, but major markets move in long cycles. And gold cycles often last many years. Media narratives change over time. First, gold is ignored. Then it is questioned. Then it becomes a daily headline. When media talks about gold constantly, a new phase has already begun. Every gold bull market follows the same pattern. Early disbelief, extended skepticism, and finally, acceleration. The current cycle is still developing. $8,000 is a psychological level. Markets do not respect human emotions. When momentum builds, psychological levels break quickly. History has shown this repeatedly. $10,000 is just a number. Real value depends on purchasing power. If money keeps losing value, gold must rise to compensate. This is not emotion. It is basic economic math. The most important thing for individual investors is understanding context. Avoid emotional decisions. Avoid leverage based on hype. Gold protects wealth. It is not designed for quick riches. Every asset carries risk. Gold is no exception. Short-term volatility is normal. Long-term direction matters more. Risk management matters more than predicting tops. No trend lasts forever. Gold will eventually peak. But current data shows no clear ending signal. Supportive factors remain strong. New pressures continue to emerge. We have reviewed the data. We have studied history. We have outlined multiple scenarios. $8,000 is reasonable. $10,000 is extreme but defensible. You do not need to believe immediately, but you should observe closely. Markets always send signals. The question is whether we listen. This video is not investment advice. Every decision carries risk. Do your own research. Responsibility always belongs to the individual. The world is changing faster than ever. Financial systems are changing with it. In such moments, gold tends to speak loudly. As 2026 begins, markets are far from calm. Old problems remain unresolved. New problems continue to emerge. Investors enter the year with more concern than confidence. This environment historically favors gold. In the first quarter, gold may move quietly. Doubt still dominates sentiment. Small pullbacks discourage weak hands. Meanwhile, large players accumulate. This is the silent accumulation phase. In the second quarter, doubt begins to fade. Economic data worsens. Inflation proves stubborn. Real rates remain negative. Gold begins trending higher consistently. The third quarter often brings acceleration. Institutional flows increase. Media coverage intensifies. Extreme predictions become mainstream discussion. Gold approaches major psychological levels. The fourth quarter is driven by emotion. Retail investors rush in. Fear of missing out spreads. Prices can rise rapidly. $8,000 becomes a common topic. When gold reaches $8,000, many will assume the top is in. Markets do not stop at round numbers. If capital continues flowing, momentum can push prices higher. The move from $8,000 to $10,000 is psychological. It represents a shift in monetary perception. Gold reclaims center stage. It becomes a core defensive asset again. When trust in fiat erodes sharply, gold can move exponentially. Society reacts as gold surges. Former skeptics ask questions. Late entrants chase performance. Risk increases for emotional buyers. Every strong rally is labeled a bubble. True bubbles lack fundamental value. Gold rises because the monetary system weakens. That is not a bubble. That is repricing. No scenario is guaranteed. Gold can experience sharp corrections. Extreme monetary tightening could slow momentum, but such tightening damages growth and ultimately supports gold again. This video is not about exact price targets. It is about understanding the system, understanding why gold matters, understanding why 2026 may be pivotal, and why $8,000 or $10,000 is not irrational. You do not need to act immediately, but preparation matters. Knowledge is the first layer of defense. Calm thinking is the greatest advantage. This is not financial advice. All information is for educational purposes only. Financial markets involve risk. No outcome is guaranteed. Monetary history is inseparable from gold. Whenever systems fail, gold returns to relevance. Not because it is perfect, but because it cannot be printed. That is its power. When you look back at this video years from now, you may ask yourself, was this only a theory or an early warning? Time will decide. Markets never wait. Thank you for watching until the end. If you found value here, share it with those who need it. Continue your own research, because the most important financial decision will always be your own.